Hi, everyone. This is Jason Barrack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today, instead of doing a normal interview, Mo Dawood and I are going to answer some of our listener questions that you guys submitted a number of weeks ago. And to start that off, one of our listeners, when we made our Ask Doug Casey a Question podcast, he had a very valid question. It's a very important question. We get this also from our paid consulting clients, so we'll put this some information out there in public. I have physical precious metals. I have a good amount of physical gold or physical silver here in the United States. Should I start moving some of it outside the United States now? How do I do it? Which company should I use? Things like this. So Mo, what are some of the options here for our listeners who have a good amount of physical gold and maybe are kind of getting scared that as the gold price rises, the politicians, the central bankers, the Keynesians that are in power are going to want to change the rules?
Well, thanks to the internet, investors have a lot of options on how they want to store their gold and silver outside the U.S. banking system. One of them is goldmoney.com, one of the more popular ones, started by James Turk. And basically, you can set up an account there, and then you buy gold and silver, and they hold it in a storage outside the U.S. And you can choose what country you want to store the gold and silver in. They have Singapore, China, Switzerland, Canada, I think Hong Kong too. So there's a lot of choices you can pick as to where you want to save your gold. And it's always good to diversify your gold and silver holdings geographically, because you never know what the government's going to do in this country or in other countries. They might one day decide to take hold of your gold and silver and devalue it like they did here in the United States back in the 1930s. So they have goldmoney.com and also goldsilver.com, started by Mike Maloney. They have a storage program as well, and I believe Eric Sprott has one. Yeah. I think so.
Yeah,
he does. Okay.
Yeah, Sprott Money has one. Eric Sprott has their only vault. Right, they have the vault in Delaware. I spoke with one of the Sprott Money brokers a couple days ago, actually. But they have a vault here in the United States. I think it's in Delaware. It's a Brinks vault. It's the vault that a lot of people use for storage for physical precious metals and allocated. But then they have a couple in Canada. But according to what their one of their brokers said, that they're planning on also copying what goldsilver.com did and what Gold Money did, and opening vaults in Singapore, in Hong Kong, in Switzerland, and possibly one in South America, maybe Panama or something like that as well. So you're starting to see some options here, but if you already have physical gold, you might have to get that gold assayed, so you might be charged in an assay fee to say store it with one of these guys. They might have to melt it down and verify that it's real metal, that it's not tungsten wrapped, or some of these other things out there in order for them to store it for you, or they might charge you a higher fee. But if you buy the bullion, I think, from goldsilver.com or from Gold Money, I think the storage fees are somewhat reasonable. They're probably going to be going up every year, but it's the best you can do right now. I mean, other than pulling a Mr. Timo, right, and or having like a gold mule and having someone swallow the gold and on an airport flight out. If you're going to go open, say, a safety deposit box in Panama or something, which, by the way, is legal. You're allowed to open a safety deposit box in Panama or Switzerland or another country, just not a bank account. I think you don't have to deal with FACTA, which is the new thing that went into the new rule that went in on July 1st of this year, which is causing a lot of compliance problems for foreign banks and American citizens, having to report everything. I don't think you have to report a safety deposit box yet.
And that's some great tip and advice. And we get a lot of questions about this, and a lot of people are concerned about the safety of our gold and silver, and it's legitimate. I mean, you can keep it in your house, but if someone tried to break into your house and steal the vault, or not steal the vault, but break into the vault, or if you have it in a box, they can take the box and leave the house.
I read a funny story. It's funny you bring that up, Mo. I've read funny stories about how a guy dug up a hole in his backyard or something. He had a big ranch, I think, in California or something, and he dug up all a big hole, and he put a lot of his gold coins in there, and then he got divorced from his wife, and his wife got the house, and now he can't go back and dig up the hole and take the gold out.
Oh,
Whoops.
plus something happened to him. How are people going to find the gold?
Yeah, metal detector maybe, or someone else
Yeah.
finds it with a metal detector. And I've also read, unfortunately, stories online. I don't know anyone personally who this has happened to, but I'm sure like it's happened, and maybe people don't admit this publicly. But you know, family and friends, they know you're into gold and silver, and you know you have a party in the house, like a family get together or a party or something, and someone you know goes upstairs to an upstairs bathroom, starts snooping around, and pocket some of the coins and leaves. So I've heard of thefts like that too. So you don't want to have all of your metal stored in just one place. And you know, you want to be quiet and keep your mouth shut, and not unless you know it's stored at a Brinks vault or something like that. You know, in a mixture of Switzerland or other places. There's some very secure. I listened to an interview with Egon von Greyerz. He brags about how his gold for his company Matterhorn Asset Management, I think, is stored at the most secure vault in Switzerland. Like, they brag about the security measures, but I'm sure the storage fees for that Mo are pretty high. But the governments, Mo, are changing the rules. I think a number of European governments and the U.S. have started to change the rules even on gold money, right, for reporting of the metal and taxation stuff. So, I mean, it is what it is, listeners. One of the main things we talk about in our podcast is rule number one: the governments are going to change the rules. It is what it is. So you're going to have to pay attention to the rules changes. You have FACTA. As of right now, you can have a safety deposit box outside the United States that's not a bank account, and you know you can go fly to Panama or Switzerland or Brazil or or Australia or something, or New Zealand, and go put I don't know, a few gold coins in there or something like that. And you can also own foreign real estate, I think, and not declare it, as long as you don't profit from it as a rental property owner. So if you just buy and hold foreign real estate, maybe you build a house there or own a condo on it, but you don't rent it out, and it's like your escape plan or something like that, you don't have to declare that as of now. But the rules are in flux and things can change. So you know, unless you own a lot of physical gold and you wait till the last minute and you want to be like Mr. T and you want to put, or a rapper, right, Mo, or a professional athlete or something, and you want to put like 5 gold chains on yourself and your wife and your kids and try to sneak them on a plane if the shit does hit the fan, and it's probably not a good idea. But
Yeah, you've seen the movie The Wolf of Wall Street when they packed the money on themselves, and even the girls had the money stuck in their bras as well. Remember that scene?
Yeah, but now, though, with the body scanners, Mo, and the pat-downs from the TSA, I mean, you can't get away with that. I mean, maybe a while ago you could have, but you can't anymore. I mean, people are so desperate in India, right, with the gold smuggling and the black market that occurred, right, to get that extra premium. There was over $100 an ounce premiums in India at one point. I'm not sure what the exact premiums are now, but there was people swallowing gold to try to sneak gold, you know, over the border from either Pakistan to India or on plane flights from Dubai to India and things like that, to, you know, try to get the gold in the country cheaper and then resell it at a profit. So, you know, hopefully our listeners don't have to do that. If you do already own the physical gold and you want to put it into one of those programs with Safe Secure, as a retail client, your options may be limited. You might get a better fee if you're a higher net worth client. It just really depends. I would call around to these different brokers, and I would see what kind of deal they can get me. But if you already own the gold, you're probably going to have to pay some type of assay fee for them to check the gold to make sure that it's legit before it goes in the vault there and is stored. Because there's insurance and other stuff on the vault storage. And I don't think the insurance company is going to agree to insure your metal and put it in the storage program and things like that until it's verified that it's really metal. And and these companies have, at least Gold Money has independent audits. So if you have so it's not going to be, you know, unallocated accounts. It's not going to be a fractional reserve, which is how banking started, you know, initially with Goldsmiths and gold receipts, right? So it's not going to be like that.
All right, so let's go to the next question. So we had a question from one of our Facebook fan page followers. And the question is, at what point do you think Wall Street will be forced to stop manipulating all these markets? So that's a good question. So right now, I mean, basically all the markets are manipulated. Gold, silver, the general stock market,
bond market,
oil market, bond market,
currency markets, real estate markets.
You name it, all manipulated. So at what point will they stop? I don't know if they'll ever stop. Maybe if we have a global economic collapse and Wall Street dies and a new stock exchange is formed where manipulation is not happening, I could see that. But for NASDAQ or General Dow Jones or the S&P 500, as long as Wall Street is around, it's going to be manipulated. And if the Federal Reserve is still around as well, these markets are going to be manipulated.
Yeah, I've read a book, and our listeners could go check this out. It's called Extraordinary Popular Delusions and Madness of Crowds. It goes back through a lot of past financial bubbles. It goes back through the South Sea bubble, the Tulip Mania bubble, John Law's Mississippi bubble. And basically, one of the main lessons I've learned is as long as there's been markets and there's been people that think they know markets better than others, markets have always been manipulated. The governments have been more involved sometimes than others. In some of those instances, the government was the one selling shares to earn extra money, like the Mississippi land shares and things like that. So it really just depends. But what we have, Mo, is a culture here where the manipulation, basically, the regulators, the SEC people, the Department of Justice, they give people a free pass. And they're basically saying, you know, that if we prosecute these bank CEOs or the high-level executives, that the bank stocks are going to collapse and the economy is going to collapse 2008 or worse again. And I think, Mo, from a top-down perspective at 30,000 feet, this all goes back to the culture and the things that people have been taught. And, you know, in school at a young age. So seeds are planted, and the seeds that have been planted is that it is okay to intervene and, you know, redistribute wealth and Keynesian economics. And Keynesian economics is the economics of intervention. Big government intervenes in markets. Big government helps pick out winners. It's fascist. It believes in oligopolies. You know, it has higher taxes and picks out winners and things like that. And then when you go back to the backgrounds of a lot of these people on Wall Street, these people are not dumb. Okay, they may have read the wrong things. They may have not refused to read Hayek or von Mises or Rothbard or Peter Schiff or any of these Austrian school economists or the free market. They may have refused to read it, but they're not dumb. They're very book smart. They probably got A's at Harvard or Yale in whatever subjects. A lot of them, whether they grew up rich or poor or not, they did very well. Most of them did very, very well in school, but they are hardcore progressives, many of them. And there's the common misconception, Mo, that, you know, these people on Wall, and I think the mainstream media and I think the Progressive Party tries to spin it this way too, that the people on Wall Street, right, are these evil, greedy, Republican, free market people, and that's definitely not the truth. Most of them are not like that. Most of them are actually hardcore progressive limousine liberals. They want to make a lot of money in the status quo system where the government is doing, you know, this and this and this, and then they want to either pay taxes because they feel guilty, or they want wealth redistributed, but since they know the tax laws around things, right, they want other people to have to pay the burden for the poor and other stuff, and, you know, they don't understand how free markets are actually more democratic than everything else, because, you know, it lowers prices, it distributes profits, it gives the little guy a chance to build a business and compete with the big guys, and, you know, without these immense taxes and rules and regulations that the little entrepreneur or small businessman oftentimes can't even pay. So our listener's question, well, I just went off on a rant there with some background information, right? So, you know, you have people with the background who have read a lot of Keynesian and Marxist teachings, whether they know it or not, from, you know, textbooks, their professors, a lot of the mainstream media, government's espousing a lot of this stuff now. There are college professors who won, you know, some of them won humongous awards at the Ivy League. And, you know, they want to believe in this stuff. They don't want to believe that all the stuff they spent years learning is wrong. And the question from this from Joe Renault on Facebook, he has three options here. Are the people on Wall Street going to learn at the point of a gun, at the point of death, or at the moment of becoming humane? Well, they view humane. The progressive idea of humane is redistribution of wealth, and that in a lot of aspects it goes back to the original guy of Marx. And the Marxist view of redistribution of wealth is that the bourgeoisie, the only way the middle class got rich was by stepping on the poor, which is not really. If you've owned a business, you know, unless you're Goldman Sachs and you steal from your clients or something like that, and then you hire lawyers to protect yourself, you know that to build a business over the long term, you have to create value. So you have to create win-win scenarios, a lot more win-win scenarios than win-lose scenarios to build a business over the long term. And I don't think that ideology, the progressive ideology, which emanates from Marx, from Keynes, from hardcore progressive people, understands any of this. They don't understand value creation in the economy. Will Wall Street learn? I think Wall Street will adapt to however it wants to adapt. Off the record, Mo, you know Wall Street people like me. Well, you and me know Wall Street people, right? We've had some of them on the podcast. Some of them won't come on the podcast. We've spoken with them in emails. We've spoken with them at some networking events or conferences. People have worked on Wall Street. And what's your view on this about those Wall Street people?
Well, a lot of people think people on Wall Street are mostly rich Republicans, but there are a lot of Democrats on Wall Street as well. But there are some good people on Wall Street, good traders that do the right thing, that don't scam their client, don't take money from taxpayers or the Federal Reserve to try to keep their hedge fund or private equity alive. But the big banks, they're mostly zombie banks, and they're alive because the Federal Reserve bailed them out. And they think it is okay because that's what they were taught in school, like you said, that it's okay for the government to bail out the banks because if they don't bail them out, the economy would collapse, which could be true, but we probably would have got out of it a lot faster if the government would have stayed out of the way,
exactly.
And the Federal Reserve did not lower interest rate to almost zero.
And the banks would have never even gotten this big in the first place in a free market, right? Because the insurance companies would have never allowed the bank. The insurance companies are normally larger than banks because they cover the bank's losses, right? And in a free market, at least. But with the Federal Reserve, there's no need for that because the Fed is, and implicitly the U.S. government too, and the Treasury Department are all in cahoots there, allowing the banks to make whatever bets they want because the Fed is just going to bail them out. So then there's moral hazard there to gamble with however much money they want. And even the FDIC insured money is that the FDIC is just an illusion of safety. The depositors get their money back, but the bankers get to gamble with the money still, and then they get the depositors get the money back, but the bankers have a heads I win, tails you lose type of scenario where they're gambling with big bets to make bonuses with risks they shouldn't take instead of loaning out the money into the real economy, to grow the economy and create jobs.
And there's been a lot of Wall Street people that blown a whistle and they left Wall Street because they didn't like the culture, didn't like the way they were doing things. Some of them were doing things unethically and illegal. We had those guests on our podcast, like Greg Manorito and Nomi Prince, and they talk about that. That these people, all they care about the bottom line and keeping their bonuses and their nice lifestyle going. And they don't care about the taxpayer that paying for their losses.
Or even their own firm 4 years from now. I mean, when Goldman Sachs was a partnership, before it was a publicly traded corporation, and Goldman Sachs was only basically investing their own money, the partners' money, right? I guarantee you they were not taking the risks that they were now. So, or if they were taking very large risks, they were very small and diversified. So they were a small percentage of the portfolio. They were well calculated, and when they were risking their own, when the partners at Goldman Sachs were risking their own money, they ran the firm entirely differently. And I'm sure they were creating more value and not as much scams and things like that as they've necessarily done recently since they went public and basically they were playing with the shareholders' money, and the executives were just trying to get rich quick in only 2 or 3 years from stock options and managing earnings higher too. But that's a problem with in general with all large corporations now, and the way we've set up bonuses and stock options and things like that. So I mean that again goes back to our problems with culture, and we have really wrong incentives, and a lot of the textbooks and other things that have been taught have been incorrect about business and entrepreneurship and money itself and banking and things like that. So unfortunately, as evidenced by a lot of the Twitter crowd and people I've had to block, there's a lot of Keynesians. So we have a lot of work to do. Some Keynesians have an open mind and they'll listen. Some of them wake up and some of them won't. So we'll see.
Yeah, and maybe down the road somebody will create a new stock exchange where it's less manipulated, and that people can buy and sell stocks without worrying about high frequency trading or naked selling or any of that stuff that destroyed the market.
Yeah. There's just so much naked shorting now, Mo. Like the original point of the stock market was there wasn't originally in the past there wasn't a lot of shorting. But now there's just so much shorting that when a small company raises capital, if they're not making money very quickly, the company's in jeopardy, of being shorted to near zero very quickly by the shorts now. So, I mean, you're seeing this now in Silicon Valley, Mo, that a lot of companies in the past that would have went public, but now they're not because they're worried about the Wall Street traders and other people destroying their shares. So you're going to see a lot of this is going to hurt the retail investor too. You're not going to be able to buy shares in as many good companies, at least in the United States. Maybe in other countries it'll be different. But a lot of technology companies, you're not going to see them go public for a while, if at all, some of them, until things change.
Right. So that pretty much wraps up that question. So let's move on to the next question. We have another question from our YouTube channel. Our listener wants to know, could you please explain what a carry trade is? What kind of carry trade there typically are, and how changes in interest rate can affect lender and borrower? So let's answer the first part of the question, and that's what is a carry trade. So I'm going to read off the definition. A carry trade is a strategy in which an investor sells a certain currency with a relative low interest rate and uses the fund to purchase a different currency, yielding a higher interest rate. A trader using the strategy attempts to capture the difference between the rates, which can often be substantial depending on the amount of leverage used. And so that's the definition of a currency carry trade. And
Which website was that from, Mo? For our listeners who want to read the definition again?
Oh, they can go to investorpedia.com if they want to read the definition. We'll put up the link below our YouTube video if people want to check it out. And so for the second part of the question, how changes in interest rate can affect lender or borrower? Well, if the central banks lower the interest rates, let's say, for example, Japan, so a Japanese investor can take their money that they have and convert it to U.S. dollar if they want to buy a U.S. bond, since the yield might be a little bit higher, let's say 3%, and they could just pocket the difference in interest rate between the Japanese bond and the U.S. Treasury bond. That's a very relatively simple example of a currency trade, but a lot of people use leverage by using derivative for carry trades. I'm not an expert in that sort of thing, but Jason, do you have anything else to add to that question?
Yeah, a few points, Mo. In terms of the yen carry trade, the yen carry trade is the most popular one. It's created, in my opinion, an enormous amount of asset bubbles. It helped fuel the technology stock bubble here in the United States. It also helped fuel other bubbles all over the globe, and it's still fueling asset bubbles. In terms of the yen carry trade, though, it uses an enormous amount of leverage, and it's interest rate arbitrage. So you're borrowing cheap yen that the Japanese central bank has artificially suppressed, because they're Keynesians, and they're all trying to have they all believe in mercantilism, and they all want a weak currency to boost exports. But now Japan was the only country doing this hardcore for a very while, but now you have a lot of countries who are doing this. So there's other carry trade opportunities based on whichever central bank is trying to weaken their currency the most with low interest rates and devaluation. In terms of the yen carry trade, though, you would load up. Currency trading offers people a lot of leverage. You can lose, you can go bust very quickly if you don't know what you're doing. If you don't have your stop set tight on this carry trade, you can borrow 100 to 1 or more in some cases, I believe, on the Forex market. So you have very sophisticated hedge fund managers. You have Goldman Sachs, Morgan Stanley, very big banks borrowing from Japanese banks or the Bank of Japan if they're large enough to borrow directly, I believe. And they're taking out humongous amounts of yen. They're converting it to another currency. One of the hot carry trades, Mo, was taking yen and then putting it into like bonds in Brazil or India. And these other countries, right, they had much higher interest rates, so you can make a really nice living off of it. And one of the reasons these guys do this is because of carried interest. And there's a tax benefit to this in the United States. I'll read an Investopedia definition of carried interest for our listeners. It's a sophisticated term. A share of any profits that the general partners of private equity and hedge funds receive as compensation, despite not contributing any initial funds. This method of compensation seeks to motivate the general partner, fund manager, to work toward improving the fund's performance. So you're using leverage, you're using basically the stupidity of Keynesians and the central bankers to try to get a lot of extra returns for yourself and your hedge fund, and you're really not paying taxes on it. So I know this was a big debate when Obama got elected. He said popular stuff about, I'm going to take it to Wall Street. I'm going to eliminate carried interest, right? I believe that was one of the platforms he ran on, Mo, after the 2008, around the 2008 financial crisis as Obama was getting his first term, but he never actually took away carried interest for private equity and hedge funds. So as long as they can borrow insane amounts of money very cheaply, invest it into another asset market, and with the leverage, they can make, millions of dollars, or if they're large enough like BlackRock or George Soros or something, they can make billions in a very short amount of time with a carry trade. They're going to keep doing it, especially with the way the tax laws are for carried interest. And it's very risky, Mo, because if the interest rates move, let's say if the yen strengthens or interest rates in Japan rise or the interest rates of the arbitrage interest rates, let's say the bond yields drop in India or Brazil, and it could affect the carry trade, and then it has to get unwound. The hedge fund has to unwind it very quickly, or they risk going bankrupt if they put on too big a trade. So these guys are trying to make a lot of money too quickly. They're taking enormous amounts of leverage risk, and they might not have their risk controls properly. And, this is what caused a lot of the bond fund problems in Brazil and in India was the yen carry trade. And it's caused asset bubbles to go up, and it's caused short-term, very quick, large corrections in other markets too, is these yen carry trades unwind. So I think our listeners need to watch the yen. The yen is an important thing to watch. If the yen's strengthening, it means the carry trade is normally unwinding. If it's weakening very rapidly, Japan could be collapsing. But the bottom line is that a lot of hedge fund managers have used this trade to make a lot of money and get rich quick. Some of them have bet wrong, like against the Japanese bond market, instead of, just betting the yen to, I guess, weaken over time. Well, in the long term, they may be right that the Japanese bond market's going to weaken, because I don't see any way how they can without, destroying their currency, really, continuing the game in Japan. Japan's been doing this even longer than the U.S. has. So, in terms of that, I guess it creates more volatility. I guess the yen carry trade creates a lot more volatility in asset prices. But the bottom line is all the Keynesian central bankers are all trying to weaken their currency. They're all trying to do this, and it creates carry trade opportunities across the globe when one central bank, Mo, decides, Japan has been weakening their yen too much, or the U.S. has been weakening the dollar too much. I'm going to weaken my currency more against them. And then the hedge fund managers or private equity firms are going to notice this, and they're going to go borrow cheaper currency from whichever whichever country's central bank is trying to win the currency wars and the competitive devaluation.
And that's a great point. And what you just talked about is what James Rickett called a currency war, where everybody is racing to debase their currency, try to enhance their export market and increase productivity and create jobs and etc. None of that is working, as people can see.
Exactly, Mo. Look in Japan and see if they're really gotten more productive, and the Abenomics and trying to devalue the currency has benefited them. It hasn't. I spoke with a listener of our podcast from Japan on Twitter in the last couple of weeks, and he was telling us his food prices are going up, his VAT tax is higher, his healthcare bills are up, his electricity bills are all up, and their food and energy imports are going through the roof. So it's not helping the man on the street, the person on Main Street. It's helping the sophisticated financier, the bankers, the politicians, stay in office so they can continue to hand out cheap money for social programs, or in the U.S. in warfare. It just this weak currency devaluation thing that the Keynesians / mercantilists are really doing is just really benefiting the people in power, status quo, the welfare warfare states of many of these governments. And unfortunately, it's creating volatility and asset bubbles and crashes and things that normally wouldn't have happened.
Right. So that pretty much wraps up the question regarding carry trades. So let's go on to our next question. We had a question regarding Bitcoin on our YouTube channel. The question is, do you think Bitcoin is a lot more deflationary than gold? So why don't you start off answering that question?
Well, this is a good question. But before I talk about Bitcoin, let me talk about my views on gold. If we were on a gold standard, and there's a lot of evidence while we were on the gold standard, the U.S. middle class became very prosperous. Okay. There was not this evil feudalism that some Keynesians and neo-Keynesians have said while the U.S. was on a gold standard. Okay, the standard of living for the U.S. middle class became very prosperous. There was a lot of inventions of new products and services, a lot of technological innovations during this period after the Civil War and before basically before 1913. And the Federal Reserve was implemented, although we were still on the gold standard when the Federal Reserve was implemented. But, other things started appearing with the gold exchange standard, which wasn't a real gold standard. But the gold standard allowed for a stable currency. The currency actually appreciated in terms of purchasing power, and that allowed confidence for capital to flow into the country. People wanted to invest into our country in the United States at that time. There was a lot of investments from other countries of people who brought their capital in because, they could just exchange it for gold, or they could, invest it in a lot of the free market forces that the U.S. did have at that time. So the U.S. had a lot of industries that were growing. The U.S. had, radios, TVs, cars, a lot of other things that were starting to get going prior to the gold standard being abolished, in 1933, where the U.S. fully took off the gold standard for Americans, and in 71, where foreigners couldn't exchange anymore either. So I think on a gold standard, over the evidence is very clear that over the long term, the currency increases with purchasing power, and the consumer benefits a lot too. So the consumer is able then to buy more goods and services, and a stable dollar is very important now, Mo. That's a question now because in terms of now with the dollar, Americans are having to work, especially middle-class Americans and people who are working class or poor who are trying to, start off in life. They're having to work harder just to maintain the same standard of living. I mean, a house in a metro area in the United States was $50,000 to $80,000. It was under $100,000 for the most part prior to the mid-1980s. And why have the housing prices, gone up more than tenfold since then? And the Keynesians will say, population, more technology in the houses, or things like this. But a lot of that is probably due to excessive credit growth and increase in the money supply and other inflation. So, I mean, you used to be able to afford, if you were even a blue-collar job, right? You were low middle class or not even middle class, right? In the past, you could afford to have a family and some kids and have some money saved up, and you didn't need to take out that much debt, and you could pay for it all on one job. and you can't do that anymore. So in terms of deflation, you should really look at the Austrian school. I don't know, it's Alex Alexander who asked the question. I don't know, Alex, how familiar you are with the Austrian School of Economics. Go to Mises, the Mises.org website. There's a book up there that you can read. I think it's a pretty short book. It's called Deflation and Liberty. And then there's other Austrian School economists there that talk about the benefits of deflation, and it will get you thinking about that. In terms of Bitcoin, Mo, I think it's good. I think Bitcoin is good. I am all for the record, I'm for competing currencies. So I really like Bitcoin from a technology standpoint. I don't know if Bitcoin's going to be the winning cryptocurrency, although it's had more investments in terms of money from Silicon Valley and programmers, and also a lot of program time for people who volunteered to work on Bitcoin for free, in terms of programming the blockchain and other things around it now. But I think that's good. And I think over the long term, competing currencies force money to be run more efficiently, right? I think over the long term, instead of these government-protected monopolies, debt-based fiat currencies that can be created in unlimited amounts, the credit supply has to keep growing, the debt has to keep growing, it's compounding in a negative way. The currency is growing, in humongous amounts. It can be printed off, in currency swaps with enormous amounts, trillions of dollars we don't even know about, that we only find out about later in 2008. I think when something is run responsibly, the supply is controlled. Even if there's 20 Bitcoins all competing against each other, I don't see that as long-term inflationary. Do you see that as long-term inflationary, Mo?
No, and also keep in mind that Bitcoin is it's not manipulated market like other currencies. So whatever happens in the economy, whether we have inflation like we have now, we have inflation, and the value of Bitcoin has been going up. Now, is that because of inflation, or is it because people are just buying about Bitcoin and they're buying them like crazy? Well, that's another question.
Well, I think personally, if I could jump here for a second, Mo, I think personally Bitcoin is going up more because that the positive fundamental aspects of it is that retailers, bricks and mortars, and e-commerce, it's a more efficient way of doing online banking and e-commerce than the old paradigm of through the banking system, especially now if you're buying e-commerce with a foreign company and it's a large transaction, now you have to do FATCA stuff. So you're going to have to do FATCA stuff, and then there's credit card clearances, and there's all these other fees that go up through the value chain there, and people are like, oh, it's insured. Well, I mean, there's chargebacks and other stuff that are a pain in the ass too if you're an e-commerce person. So I think Bitcoin is at least. I like innovation. I like disruption. I like how it's going to at least force the status quo to adapt and lower the fees and become more efficient at the very minimum. But in terms of all these Bitcoin, Bitcoin and all the other virtual currencies, I don't know which ones are going to succeed or fail or not. I mean, there's so many different ones. People are naming coins after themselves. I think we just saw, Mo, there's 2 new companies, Anthem Coin and I forgot the other, that are doing virtual currencies now that are at least partially backed by metal. So, I mean, it's good that from a competing currency standpoint, let the market decide what it wants to choose best. Instead of, these government-protected monopolies with debt-based fiat currencies that, you have to transact in, and that governments can inflate at will, and they can do all sorts of things, with bail-ins and bailouts, and potentially, a 1933 devaluation. If free market forces are allowed here in the U.S. and we do have another 2008 crash, I think we will potentially have a 1933 type of copy event where the Keynesians, will say nothing else we do to create inflation, enough inflation is working, and, they'll devalue your bank account against gold, or they'll do a bail-in or something else. So I think Bitcoin, that's good for the market. I think Bitcoin is gaining in value, so that is deflationary in terms of its gaining purchasing power. I don't think that's bad for anyone at all. In terms of its price increases, it looks more deflationary than gold, but like you said, Mo, that's because gold and silver are being heavily manipulated, and Bitcoin, maybe, there's high-frequency traders now because there's a lot of day traders now, day trading Bitcoin. Maybe they manipulate the market a little bit here or there, but it's not, the manipulation is not to the level that gold and silver are, where, you have a hardcore cartel of bullion banks and high-frequency trading programs and other things that are trying to cap the price and, change sentiment and paint the charts and things like that.
Right. Oh, who knows what would happen if we had deflation? Maybe people would dump Bitcoin and buy dollars because now the U.S. dollar would be more valuable. I think one of the reasons why Bitcoin was created, because the U.S. dollar was losing a lot of value and people wanted another currency to use, and also people wanted, because the government, like you said, the government have a monopoly over fiat currency in this country, and people wanted a different currency that had better value compared to the dollar. So
have you looked at the white paper, Mo, that Satoshi Nakamoto wrote? He seems to me to be a gold bug, and he seems to me to be an entrepreneur trying to solve a market problem where the past people who created eGold or Liberty Reserve, right, where they tried to do a currency that was backed by gold, the government targeted them, put them out of business, said they were laundering money and other things. Well, I mean, look at how much money is laundered in U.S. dollars and U.S. treasuries by the big banks for drug cartels and other things, and they get a little slap on the wrist. It's just, these guys are laundering enormous mind-boggling amounts of money, hundreds of millions, if not hundreds of billions of dollars a year in drug money and other stuff for, criminals. And the banks get a slap on the wrist because they're part of the status quo. They're protecting, the government's monopoly, the government's ability to continue to grow the welfare state and borrow as cheaply as it wants. And then you have a competitor in Bitcoin, and you have like any little person targeted for, the allegations of stuff. I don't know if they're true or not, which Charlie Shrem or Silk Road guy, I don't know how much is true and how much is not. But unfortunately, Mo, I think you're seeing this with like the World Bank. I think they're saying that Bitcoin is like a terrorist thing or something like that. The World Bank issued a report saying that like Bitcoin is terrorist money and things like that. People are not going to believe it when their food bill is going up and things like that. That people are going to wake up and realize that these governments and central bankers and politicians are lying about protecting my fiat currency. And I think that's the best thing about Bitcoin is that the more technologically savvy people who are not necessarily libertarians, who don't know anything about gold or silver, are starting to question now and ask what is money. So I think that's like the first seed to them starting to think, well, why is Bitcoin better than the dollar? Why is Bitcoin better than the dollar? How is it different than the dollar and things like that?
Right. Well, regardless, virtual currency here to stay, whether it be Bitcoin or Litecoin or any other coins out there. They're here to stay. We'll find out in the next decade or so which virtual currencies will come out and be the best one in the market. So let's go to our last question we had from our listeners. And this last question from our YouTube channel is regarding having physical possession of stock certificates versus keeping your holding in a regular online brokerage account. And this listener wants to know which way to go and what the best way to proceed, because a lot of people like to buy junior mining stocks and they don't want to get the paper in their hand because it's very volatile, and if they want to dump it, it's going to take a while if they have the stock certificate rather than going online and just clicking the button and selling it. So this listener wants to ask us for our advice on what to do with that one.
Well, first off, before I talk about the pluses and the minuses, positives and negatives, whether or not you should direct register your shares and try to get the certificates, let me just say that Tekoa da Silva, he's now working with Sprott Asset Management. I think he's working with Rick Rule's company in California. But you could go to his website, Bull Market Thinking, and he used to sell a really good report on there called Bulletproof Shares. I don't know if he's selling it anymore, but maybe you can send him an email and get the report for free, because he's making pretty good money, I think now as a stockbroker, so, helping people pick out good resource stocks with Rick Rule. But he has an in-depth report, so I just want to plug that real quick if you want a lot of answers. But in terms of just a real quick summary here, the pluses are that you own if you got your share certificates and stuff like that. If Wall Street decides to do an MF Global or something like that, where there's a John Corzine running things and he's been stealing from customer assets, and instead of using the firm's own money for things, which there might be other firms out there that are doing this, we don't know for sure. But anyway, though, in terms of avoiding that, if you get direct registration of your shares or you get the certificates, that would be good. But then you'd have a less liquidity. There's one if you direct register your shares, you don't have to get the certificates. You can still trade your shares on an exchange, but the market's going to be less liquid, and I believe a lot of online stockbrokers charge a lot more money for trade. I forgot what the other for direct registration exchange is. But it's a lot less liquid market than the normal markets where the shares are traded on now. So that's one option. And the other one is if you actually get the share certificates, first off, Wall Street does not want to give you share certificates. So you're going to have to spend a lot of time. If you called up, say, TD Ameritrade or Scottrade or Charles Schwab or E-Trade or Interactive Brokers or any of these guys, and you spoke to the broker, you're not going to be able to get your share certificates in 10 minutes. They're probably going to put you on hold, and they're probably going to they probably don't even know the procedure, and they're probably going to make you speak to 4 or 5 people, and it's going to take a couple hours, and you're going to have to spend a couple $100 probably per share certificate to get it printed out. So once you get the share certificates printed out, you can't exactly trade the stock then. So it's basically like maybe for a company for buy and hold, set it and forget it. So for a company like maybe Silver Wheaton or Franco-Nevada, where you know that they have their costs fixed in their gold and silver costs fixed, and they have a diversified portfolio, and they're just gonna you want your shares, you don't plan on ever selling your shares, and you're just gonna get your dividend checks in the mail then too, then that's fine. But for a stock maybe that's like a more volatile mining stock mode, like you said, that's a negative probably to getting the certificates, because the management company at the miner could, because it's a more volatile business, costs fluctuate, bad things can happen at one individual mine. Normally the miner, if it's a smaller junior miner or mid-tier miner, has to gamble most of the company on 1 or 2 mines, and you take a hold of the share certificates and the management team screws up the company, and the company's bankrupt and you can't dump the shares in time. So there's positives and negatives to different things here. It's time and money to get direct registration. It's time and money to get the share certificates. The direct registration option is the in-between option for regular shares on an exchange, which are held in street name by the broker. The direct registration, they charge you, I believe most brokers charge you more per trade, and the markets for each share thing are a lot less liquid. So if you own a lot of shares and you direct register and you eventually plan on selling your shares, it's going to be difficult to sell your shares in large blocks. But you can probably sell your position over time, but you're going to have to do it over a long time and very slowly. So those are some of the risks in terms of what investors can and cannot do.
And also, if you have an online brokerage account, you can look at the financial health of your brokerage account and look at their financial statement and see their assets and their debt and their liabilities and how much derivative exposure they have, and see if they have a separate commercial and investment banking, unlike MF Global, which they have everything all in once. So like other brokerage account, like interactivebroker.com just has, I believe they just have the brokerage account. They don't have a investment banking department where they, like MF Global, where they take your money and they risk it on stupid derivative, like what John Cordine did. So so I recommend people to do that. Look at your broker account, look at their financial house, and make sure they're in good standing as well.
It's a very good point, Mo. And some of these larger firms, Mo, people think they're safer because they're larger, but normally a lot of these larger firms know that like a lot of them are basically like hardcore investment bankers, that some of them are running these firms even if they're not. The firm technically isn't an investment bank. So some of these firms like Charles Schwab, they could sweep a lot of the cash that customers hold in their account or try to offer you a percentage return. I've heard Porter Stansberry talk about this in podcasts where he had a lot of cash in a TD Ameritrade account, and Goldman Sachs was trying to get very high net worth clients at TD Ameritrade to agree to give up a lot of their cash so Goldman Sachs could go and invest the money. So they're looking for ways to leverage up. So you just be careful out there about who your broker is. Right now, there's a few. E-Trade is pretty good. Interactive Brokers is good. TD Ameritrade is fairly good from what we've heard. I haven't heard that many negative things about Scottrade. It's kind of a discount one right now. Charles Schwab is, if you're buying Canadian stocks, Charles Schwab and TD Ameritrade tend to not be very good ones because I believe Charles Schwab charges over $50 per trade to buy Canadian stocks, and I think it's around that much for TD Ameritrade too.
Yeah, if you want to buy foreign stocks on different exchanges other than the U.S. exchange, Interactive Broker is a good one because they don't charge that much commission to buy and sell stocks in the U.S. exchange and also in other exchanges around the country as well. So if you want to do that, I'd recommend looking into Interactive Broker.
Yeah, and E-Trade charges are $10 or $12 per trade for foreign stocks, but they do it over the counter. But they have fairly liquid over the counter markets because they have a lot of stock traders with E-Trade accounts. So it really just depends on your preferences there. If you want to own Canadian mining shares either on the TSX, directly on the TSX exchange or TSX Venture, or you want to own them over the counter, it just depends on different options, how much capital you're going to put into each individual mining stock, position sizes, and things like this. So everyone is different. These are types of things Mo and I handle with our consulting clients that we help. We talk about issues like this with them, and they get personalized and customized service.
Right. So that's all the questions we had from our audience. So if anybody else had any more questions, they can submit it on our YouTube channel, our Twitter account, Facebook fan page, or they can go to our website, wallstreetformainstreet.com, and submit their question there. And also check out our other podcasts on YouTube and iTunes as well. So, Jason, thank you for your time, and until next time, everybody, good night.